Welcome to Inside, ladies and gentlemen. How y'all doing? I'm your host, Dave Jones, and we are in season 9 of the Inside podcast. And it's crazy that we're even here. And I please just make sure that you hit the subscribe button. We are back. We got a lot of good stuff. Today, we're going to be talking about assumable loans, and I hope that you stick around to listen. Before I get into my guest today, I want to talk a little bit about the market and where we're at in the market. The Fed just decided to pause rates. It is September 29th today. Or is it the 29th? No, I'm sorry. I'm ahead 1 week. It's the 22nd. I'm already there. I'm living in the future. I'm living in the future. No, but the Fed just decided in the September 20th meeting to pause the rates in terms of the basis points. And so our mortgage rates have remained here. And in November, they're going to have another meeting. And I'm looking at the CME Fed Watch tool, which is kind of predicts what they feel the Fed is going to do, and it's sitting at about 72% right now. My guest and I, we were talking before we went on. What will they do? I don't know. I don't have a crystal ball. And honestly, what I tell people and what I'm doing is I'm not worried about things that I can't control, and I'm worried more about things that I can control right now. So let's bring our guest in to talk about assumable loans. This person is an agent of 9 years, which it just blew my mind. But then I thought about it. I was like, wait, we're in year 6 of Abode, so that makes sense. And he has a baby. Watch him get married. He's been on the podcast before. Actually, fun fact, he was the first podcast we've ever created, and it was about earthquake insurance.
Baby.
It was about earthquake insurance. So, man,
that's right.
Ian Broadie of the Brodies, thank you for coming on the show to talk, man.
Thanks for having me. Absolutely.
And the funny thing is like you, I remember when this was last spring. I remember you called me up and you were really excited about this. And I was standing outside. It was on a Friday like this. And I was standing outside of Foss, I think. Or it might have not been.
Yeah, that's right.
I don't know.
Yeah, no, you were at Foss.
I was standing outside of Foss. I literally was outside the office, and you were like, "Hey, I got this great idea," and I was like, "Ooh, that sounds dope! Like, yeah, let's do it." And so now we're finally recording the podcast about some months later. So I'm really happy that you're here. How you doing, man?
Fantastic. Yeah, fantastic. Yeah, assumable loans. I mean, ever since we started seeing, it was about a year ago that we hit eclipse 7%, and it's taken us a long time to kind of figure out how this whole thing works. But, it's an exciting new thing. And I think it's a wonderful opportunity for buyers in today's market. It's, I always tell my buyers, that we're going to get into it. There's a lot of stars that need to align to make this work. But man, if you can make it work, it's a really great time to go after assumable loans.
Yeah, for sure. I think that's a good preface too. Then we were talking about this is, it might not work for everybody, and there are some sticky points.
It's not going to work for most people. I mean, honestly,
especially, agreed. And especially like if you have a VA loan, for example, and you want to do an assumable, you give up that VA eligibility if you do. You know what I mean? There's just some things that are sticking points too.
Although there's ways around that.
Okay. Well, maybe we can get into that later. So, in terms of assumable loans, talk to me about what you've learned so far in simple terms, what an assumable loan is, and how does it differ from a traditional mortgage, especially in the context of this market where we have these high interest rates?
Yeah. So assumable loans in a nutshell. Okay. So let's say, a general, when you want to go out and buy a home, the way we've always done it, you go out to a lender and you say, hey, I want to get a loan. Can I get pre-approved? They tell you what you can get approved for. And they're going to issue a new loan, a new mortgage for you to fund that deal so you can go purchase something. Okay. An assumable loan means that you're going to take over somebody else's existing mortgage. So that's really the difference here is that, for the last decade, because we've been in a market where rates have been dropping every year, there hasn't been an incentive to take over somebody else's mortgage. But in a market where rates are increasing, this becomes an attractive option. So throughout history, this has been a thing, but it's only interesting. It's only something worth the hassle when you're in a market where rates are going up. And so what you're doing is you're taking over that existing mortgage and you're basically just continuing payments on it. It used to be quite a bit easier in the past, and so this was really popular through at various times. But now after the Dodd-Frank laws. I think those were what they were, but they made it so that now it's a lot harder. You can't just wrap a loan, and most lenders put some stipulations around it. But where this becomes exciting is any government-backed loan, meaning FHA, VA, or USDA, is mandated where they're required to, the lender needs to, is required to allow the assumability of that loan. And so any one of these government-backed loans is an option where you can go in and you can take over. And the reason that this is exciting is because we all miss the 3% days, where that was an exciting time. And there are a lot of people, I think it's something like 80% of all mortgages held in the United States right now are below 40%, or sorry, below 4% interest.
Yep.
And I think it's like 50% is below 3.5% interest. So the vast majority of mortgages out there are going to be this attractive rate. And now you go shopping with a lender and they're going to tell you 7.5%. I mean, right now today it's like 7.6 or 6.25, which sucks. Yeah, well, I mean, it's the reality of the market right now, but it makes it a lot tougher. And so that's why we've seen activity has dropped so much. But if you have the ability to assume and take over somebody's 3% interest rate and have those lower payments of yesteryear, that's a exciting opportunity. And so every time I start talking about this with my clients, they say, "Oh my gosh, let's do it." The reason, so now we talk about the downsides and the reason that this isn't going to work for everybody, and why it's tough. First and foremost, we can't change the terms of the loan. So we've seen a lot of appreciation over the last few years. And if somebody bought their home for $400,000 and now it's worth $500,000, there's a $100,000 delta there. And I want to start with this one because it's the biggest disqualifier here. You need to have $100,000 to make up that difference. That's a lot of money. And for move-up buyers, who are the main folks that have stepped out of the market at the moment, are the move-up buyers. But for move-up buyers, this is an opportunity because you can sell your home with that equity that you may have, also seen go up $100,000, or you can borrow against it with a HELOC. There's various ways that you can make this work. But you do fundamentally, to really be realistic about this, you do need to have a lot. You need to think of this more as like your 20% down borrowers will be pursuing this. Your 20% in that borrowers. So I lost half the crowd there, but
no,
but that's going to be a big part of this.
There is another part to that, though. I think that if you're looking at someone who may not have that equity, or maybe they need to move and they just bought last year, and maybe that equity doesn't exist, I think it's more doable, or it's more feasible when you don't have that big delta that you speak of, and that's what I look at, and so. Like, how can they provide so I think you kind of talked about that, the financial advantage to buyers that it provides, which is taking over, assuming a 3%.
Well, yeah.
Or whatever.
I mean, you think about, your mortgage payment at 3% is, depending on the size of the mortgage, but around $1,000 less per month. I mean, we're talking about real money here. It makes a big difference. $1,000 less per month is a big deal. Back in 21, 22, 2020, most of my buyers were comfortable taking on around a $25,000 to $3,000, $3,500 purchase, monthly obligation. That really seems like that's where the majority of people were kind of sitting, your average folk. And now the goalpost has moved. It's closer to $4,500 a month is now what most people are paying. And that's why we've seen so much less activity. That's a lot of money. That's a lot.
That gives
me
the hives, man.
Yeah, I know. Yeah.
Hearing that just makes me go, wow. And I'm sitting here like, can't wait to get rid of my little mortgage that was more around where you're talking. But yeah,
I know it's painful. And, this is why this year we've done a lot of duplexes. I mean, it's been, people are looking for a way to, this is another topic, I love talking about my duplexes, but, but it's been, in this market, boy, oh boy, it has been exciting because I just closed on one in Gig Harbor, beautiful, well, one side of it's beautiful, the other side needs some TLC, but, he bought it for 730, I think. And his He's going to rent out the other side for 2,400, and he's going to be living on his side for 2,200, 2,300.
Yeah.
He's literally living for less than what he's going to be renting the other side for. And then, he's a cool guy, and he's used to living on yachts,
Yeah.
and he's going to rent out the other rooms and lower his cost of living even further. The point is, there's always solutions. And in this market, that's a great solution.
Hmm.
But living in a duplex isn't going to work for everyone. Another tool to stick in your tool belt is these assumable loans. And,
Hmm.
going after, if you can find a property that, and so the bringing down 100 grand or whatever the difference is, there are other ways to work around that. And we can talk about it more in a moment. But there's a few things that need to happen. So one, you need to have, you need to be a borrower who has the means to make up that difference, the $100,000 difference in this hypothetical
Hmm.
situation. You also need to have a seller that is going to be game for this, because the process takes anywhere between 2 and 4 months, and your
Hmm.
standard transaction is 30 days or less. I mean, I have one that is taking 5 days. We're going to close by the end of this next week. We just got under contract yesterday, 2 days ago. Um,
Congratulations.
yeah, but what I'm saying is, speed is important in those negotiations.
Yeah.
It makes a big difference depending on the seller's situation, especially if they've got a vacant home that they're paying a mortgage on that, is burning a hole in their pocket.
Hmm.
Um, that's a factor. And so, and there's some risk too, because this is a new thing that nobody's really done before, and people don't like to admit that they don't know all the answers. Nobody in this market really is able to say confidently, I've done 1,000 of these, and no problem. Like, this is
Yeah.
X, Y, and Z. This is a new thing in our market. It's going to take some reps to, get that confidence. And I think that agents maybe they're going to position themselves well by getting comfortable with this and learning about it as much as they can, so that they're ready when the opportunity, when they have the opportunity to be on this and be an advocate for it, instead of gearing their clients away. Because unfortunately, I've experienced that a lot. I've been pursuing this, and it's been difficult getting not only the
Hmm.
seller, but getting the listing agent to get as excited as I am about it. Because it is work, and it takes 4 months, and
Yeah.
that's a lot more work. Whereas if they have a standard transaction that they've done 1,000 times sitting on the table, but that's going to take 30
Hmm.
days to close, and you have the confidence, and that's going to close and be no problems. That's a compelling option. And so the reason I'm
Yeah.
saying this is, frankly, you need to have a motivated seller, somebody who this is going to work great on those listings that have sat on the market for a little bit long, and they don't have any other
Yeah.
competing offer. They're going to have a little bit more of an ear to listen to your proposition, and you'll be
Yeah.
able to have this conversation a little bit more. This is why it's worth your time. I'm willing to potentially pay more for this property if I can assume the mortgage, because it's more value. There is literal
Mm.
value attached to that assumable mortgage. The house is worth
Hmm.
more money. This is like an asset, just like a fourth bedroom might be another asset, or an attached garage. This is an asset that you can sell with, to increase the value of your home by selling off this assumable mortgage. But it does take work. You need to have, you need to, so you need to be a buyer who can pursue this, meaning that you need to
Yeah.
have cash potentially. You need to find a home that you like that just so happens to also have a seller who has a government backed loan
Yeah.
and who's willing to go through this process with you, spend 4 months or however long it takes to, from what I understand, Wells Fargo has really jumped on this, and anybody who
Oh,
has
really?
apparently they've really funded this department, and they're
Interesting.
really wanting to lean into it, and so they're able to get through these loan assumptions in 60 days or less. From what I understand, they're a wonderful company to work
Wow.
with in this regard. Yeah. Whereas other companies have not funded this department, and they are not leaning into it. And so you're needing to twist some arms, and that's why it's taking 90 to 120 days in some of those cases.
Yeah.
Um, so,
Yeah.
you're the perfect buyer. You find the perfect seller who just so happens to own the house with the government loan that you want.
Yeah.
If all of those things come together, and if the stars align, wonderful. Dreams come true. You know?
Yeah. Yeah. I'm glad you're walking us through all of that. I'm glad you're walking us through that because I think that it's important for people to hear the pros and the cons because there are some, like you said, it's a special situation. So I'm glad you brought up the sellers too because from a seller's perspective, what are the what are the advantages of
Yeah.
offering an assumable loan and how does that influence their ability to sell the property? You just said it takes like 4 months.
Hmm.
However, we are in a market where things are sitting a little bit longer. People are getting a little antsy about that, but I'm like, this is kind of normal, actually. I mean, things
It
shouldn't
is.
just be selling in 2 days, or a
Yeah.
weekend, like that's just not normal. So this is more normal. It feels normal. Like
Hmm.
it feels like at that 30-day mark, you're starting to see stuff get more. I don't know. This has been weird.
Hmm.
This market, not
Yeah.
weird,
No,
but
it's a good
so
thing.
what are the advantages from a seller's perspective? Like, why should they offer an assumable option?
So the way I view it is it's literally an asset.
Okay.
That 3% mortgage is an asset that you can sell with your property. And it's only just like trying to think of a unique asset, but there are like a detached shop, for example.
Okay.
Having a shop on your property, you've got a attached garage, and then you build a shop on your property. That is an asset that is very valuable to a percentage of the market. It's not going to be valuable to
Okay.
everybody, but
Right.
it's going to be very valuable to the folks that have boats or they have a bunch of cars or they want a wood shop to work in, whatever. That is something that is not going to appeal to everyone, but it's going to appeal to a portion of the population.
That makes sense.
This assumable mortgage, I mean, theoretically, anybody would want it, but because only some people are going to be able to pursue it, it's like that, where it is going to increase. I believe it is something that you can advertise as something that increases the value of your property, like a solar panel will increase the value of your property. Um, it will, but you have to market it well. And you have to,
Hmm.
position yourself for it. And, if you can do some legwork upfront to try to speed up that process with your mortgage servicer so that you can really
Hmm.
market this as an asset to your potential buyers. And you may end up selling to
Yeah.
somebody that is not able or interested in pursuing your assumable mortgage. But if you find a buyer who is willing
Yeah.
and your seller is willing, and you could sell your home for more money because of this. And so
Okay.
that's really where the value is. Um, it's also, if nothing else, it's something that I see a lot of agents, and when I talk about the agents that are not willing to cooperate, this is some of what I'm seeing. But a lot of agents are marketing the assumable
Hmm.
mortgage without really much of the intention to actually go through that process, but just because it gets people calling. They're like, "Hold up, I can get a 3% mortgage on this? No kidding." I mean,
Yeah.
that's exciting. That creates buzz, and that's going to get people going through your door. If nothing else, I mean, that's
Yeah.
valuable. So,
I have heard some things about, folks potentially like I'm glad you brought that up. So because I want to talk about the VA part because we did say we come back to
mhm,
that. And because there is a component, like let's say you might have an agent who's doing that and they don't understand or don't know that like their seller, let's say it's the seller who has a VA loan or bought that house and it was a VA loan because it is a government backed loan.
mhm,
And they assumed, and it was assumable, they lose that VA eligibility if they allow someone else to assume that loan, and so like you said, there's a way around that. But like
yeah,
before we even get to that part, like there's people not even telling people that that's going to happen or is a
mhm,
possibility if they don't have this other workaround, or if there's not a partner, let's say that's also military and has access to a VA loan, and they potentially can move on and just use that person's VA loan. But
mhm,
like that's not even being discussed. It sounds like in some cases. And so, what do you say to that?
yeah. So the VA entitlement is okay. So there's a couple things here. Um, there's a lot of VA out there, especially here in Washington.
Yeah.
I'm in Gig Harbor. We've got bases all around us: JBLM, Banger, PSNS. We've got all these bases around us. So we've got a lot of military personnel here, and we've got a lot of VA, and a lot of people own VA. These VA properties, especially military turns over a lot. So a lot of people who have bought over the last couple of years have these VA mortgages, and unfortunately, agents like me bunch of knuckleheads didn't plan for the assumable mortgage feature. And so was really encouraging, and you know, a lot of other agents were really encouraging for our clients to not purchase with FHA, or, you know, that it's worth springing for the extra five, you know, instead of putting 3.5% down, if you can put 5% down, then, you know, you're gonna, because of the PMI, they changed the FHA rules back in 2016 or 2017 or something, where PMI no longer falls off when you hit 20% equity. And because we were in a market where values were appreciating, and we also didn't think that we were going to see 3% forever, we encourage our buyers to purchase with a conventional loan if you can, because when your home value appreciates to 20%, PMI will drop and you'll save a couple $100 every month, and you won't need to refinance to make that happen.
And tell people who may not understand what PMI is. What is PMI? What are you talking about when you say PMI?
Primary mortgage insurance. So it's an extra 0.75%. Basically, the easiest way to think of it is it's 0.75% interest rate bump. So if you have a 3% mortgage, but it's FHA, then you really have a 3.7 blah 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 interest rate.
Yeah.
That's the easiest way to think of it. So whenever you buy a property with less than 20% down, then you're going to have PMI no matter what. Well, not no matter, I mean, but with conventional and FHA, you'll have 20%. But once you hit that 20%, with conventional, it falls off. And it used to be that way with FHA, but they changed it. So now with FHA, it stays on forever unless you put like 10% down or something like that. There's things that happen. Really? It stays on forever. It never comes off anymore. And so, you know, and that's not a big deal. You know, like I talked to buyers about the assumable mortgage. I had a listing that had an assumable FHA loan on it, and I would pitch it to potential buyers, and they're like, I don't want to have PMI, because this FHA loan had PMI on it and it wasn't going to come off. They're like, I don't want to have PMI. And I'm like, okay, don't think of it as having PMI. Think of it as instead of a 3% interest rate, it's a 3.7% interest rate. Right. And now compare that to your 7% interest rate. Which one would you prefer? Yeah. You know, that's talk brass tacks here. And so, anyway, so I'm kind of going, all I'm saying is that unfortunately, there's not that much FHA, because then the folks who did have FHA, you know, lenders were pursuing them. Hey, you want to refinance and take that PMI off, save a couple $100 a month? You know, that was easy business for them. And so a lot of the FHA, there's just not that much FHA out there. But there is still a lot of VA, because VA doesn't have the 20% PMI requirement. And so there wasn't an incentive to refinance out of VA. And so the reason that we're talking a lot about VA today is because that's really what the majority of assumable mortgages are going to be out there. USDA, frankly, just doesn't really exist in our market. Gig Harbor, you know, anywhere on the Key Peninsula is considered rural. And so you know, you have the ability technically, but there's a longer conversation, but there's an income cap that makes it so that you either qualify for USDA, but you don't qualify to buy a house, or you qualify to buy a house, but you don't qualify for USDA. So there just wasn't a whole lot of USDA. So that means VA is really the only option. Now, military personnel are on fire about this assumable mortgage world, because for them, this is the easiest thing in the world and a no-brainer. For VA, if you find a home that is owned by VA personnel who bought their home with a VA, and you know, most of the time VA people are buying houses around the base, which also happen to be where the other VA loans are. So a lot of the homes that they're looking at have this VA mortgage on it, and it's, you know, if they bought in 2020, 21, or 22, then they likely have a very competitive interest rate. Yeah. And what they would do in that case is transfer entitlement. And so everyone in the military has a certain amount of entitlement, and the entitlement is military side only. It's not really for the lender. It's just like the VA keeps track of your entitlement. And so if you're buying a $500,000 house with a $400,000, you know, VA loan on it, then your VA buyer can come in, qualify for that loan, and then transfer that VA entitlement from the seller to the buyer's entitlement. And now this seller is free to go use their VA loan again later on down the road. They have not sacrificed anything here.
Okay.
So that's a really attractive proposition. Now, what you were referring to was an alternative path, which I think sellers are going to be a lot more resistant to. But most people think of this VA assumption as only working for military personnel, but there actually is the ability to sell your assumable loan to a non-military person
Oh,
and give them your entitlement effectively.
yep.
And so now,
Yep.
this buyer is going to keep your VA loan, and you're going to have, your VA entitlement will be wrapped up in that mortgage.
Yep.
And this is a longer conversation where we may talk, at some point with a lender about the fact that it doesn't mean that they can never use the VA loan. And again, it just hampers their ability to use the VA loan. But for this, the value of this conversation is really just they can give their entitlement to somebody else. So your average Joe
Yeah.
Schmo, you and I, non-military personnel, can go
Yep.
and take over somebody's VA, 3% interest rate VA loan. And that's actually as soon as we get off the phone here, I'm writing an
Hmm.
offer on a property that is exactly these parameters. It's
Yeah.
500,000
Yeah.
with a $400,000 VA loan on it. They owe 404 on it. They bought it in 2020. They owe 3.5%. And we're offering with my non-military personnel to assume their mortgage. I've already pre-negotiated that with the seller, so I know that
Mm.
they're willing to do that.
Yep.
And we're going to go through this process, and we're going to see. They've said that
Well,
they're willing. Yeah,
yeah, let's get it. We gonna have to have a part two to this and get an update on
yeah, that's
how
right.
this went,
Yeah.
man. For
Yeah, it's
real.
gonna take a few months. It's gonna be a it's
It's
gonna be a
gonna be
process. We're gonna get through it, and we've got a lot of things that we need to work through. We've got, my
2024.
seller 2024. It will be 2024. It 100% will be in 2024 because we've got a lot of things that my client is vacating a property. They don't want to sell their property, so they're going to keep it because they have a 3% on that one too, and they don't want to sell that.
Yeah.
So they're
Yeah.
keeping that. They're going to be renting that out, and anyway, it's part of a longer conversation, but
Yep.
there's a lot of things that we need to work through. But this is why you need
Yep.
a motivated seller who's willing to go through these hoops in order to sell their home. And there,
Hmm.
for us, we would not be willing to pay 500 for this place necessarily if it's been sitting there, and
Yep.
the market. But if we can assume that mortgage, then we happily pay that because the mortgage payment is going to be 1,800 on this, and
Yeah.
that's a lot less. Whereas it would cost 3,000 a month if you were to go all in with today's rates.
Yeah, there's one part that that people need to know and listening, and if you're a buyer or a seller or someone that's just in the market and trying to learn about some things, there's a third part that we haven't talked about that you need, and that's a knowledgeable realtor. So if you have not, you've been listening to Ian talk, like he clearly has, if he doesn't know something, he's going to go look it up and research the heck out of it. If you don't know, if you know Ian, you know this. And you just need to have someone that has your back and also understands what's going on, because I feel like whenever there is something new or we do have a shift, because I have a feeling that these are going to be around for a little bit, just as an option, just because I don't, as we were talking before, I don't believe the rates won't be 5 or 4 anytime soon. Like you might get a 6.5 next year. You might.
Yeah.
I mean, I don't have a crystal ball. I don't know. But I'm just saying, I'm not expecting things to just go dipping down as quickly as they went up. That's not going to happen.
No.
So like it's going to be a step down. So like let's say when we're at 6.5, well those 3.5 still look way better than a 6.5 or a
Yeah.
6. You still got a lot of people, like you said, what is it, 48% or something, under 40% or under 40%, under
80%.
80%.
80% under 4%.
There you go.
Yeah, 80% of all outstanding mortgages are under 4%, and so that's the lion's
So
share of the market. Yeah,
there you go. I mean, I think that there's data out there that suggests that this will, some way, shape, or form of doing an assumable still will be an option. It's no
yeah,
different than like how 2280s, remember those? I mean, like
yeah.
we haven't seen
Came out
2280s
of
since
nowhere.
that came out,
Uh-huh.
like it was there. You just needed it for that moment, and that's
It
why
was a
it's
requirement.
very
Yeah,
important to have a knowledgeable realtor who is up on the new trends and how we get these things done. So that's my
yeah,
long sponsored ad for Brody, the Brodies, as real estate agents and Windermere Abode.
yeah. Well, and I mean going looking to the future. You kind of started alluding to that a little bit, and I think that these are going to become more valuable. We talked about, the benefit to the seller is that these are a valuable asset. Right now, buyers aren't really looking for these. And as I get these conversations, as I have them more and more with people who are looking for value, majority of my clients, I have the conversation like that. I try to encourage my clients to go for value, look for value. When I give you the keys, I want to say, you made money today. And so, I have a lot of these value add buyers that that are looking, and I have a small section of them that's just kind of there. This one that we're writing the offer on was just, when you find me a property that I can assume, give me a call because I'm going to jump in on that. And they're kind of just, they're active, they're pre-approved, they're ready to go, but they don't want to be picky on the house. They want to be picky on the ability to assume a mortgage because there's value there. Especially if you're bullish on rent rates, which I am. And so, so anyway, but I do think that these are going to become, because so many people have these mortgages, these are, once people are more comfortable, they're so new right now that nobody's talking about them, but when people become comfortable with it, they're going to become more valuable because more people will be looking for them. And then you're going to be able to negotiate this a little more effectively. It'll loosen up a segment of the buyer, of the buyer pool that currently sitting on the sidelines. These buyers that I'm talking about, I have these conversations with them, these are people that would not have bought previously, who have now decided that they're going to buy because of this opportunity. So as this knowledge goes out there, I think is going to free up these potential buyers who are interested in pursuing these mortgages. And, when you have more buyers, you have more value. So I think that there is a situation where these are going to become more valuable. The other thing is lenders. Let's all pour one out for our lenders because, boy, they're having a hard time. It's been a busy decade because people have been refinancing every single year as the rate drops every year. So it's easy to call up, hey, Joe, you want to refinance again? Great. I'll send over the paperwork. Yeah. That was something like 80% of all of their business was, I'm making up a number there, but a lot of their business was this refinance market. And that's disappeared overnight. So lenders are in a tough spot. And so lenders are getting creative and they're coming up with solutions. And one thing that I may be out there, but I haven't found it yet, is tackling this market. Lenders, golly, they're not going to like this message because lenders are not involved in this process. Your mortgage broker is not going to be involved in this process. I do encourage my clients to get pre-approved with the lender because that helps with the conversation. But I try to be frank with my lender that, hey, we're going to try this. It's probably not going to work, but I want you to be aware of it because you're putting time and energy and I value you. But we're using this pre-approval as validation for the seller. That's another conversation. But if, for example, if this offer gets approved, then George Lane, my go-to guy, rock star, is unfortunately not going to be involved in this process. We're going to be working with the mortgage servicer to take them through this approval process. And, so anyway, mortgage brokers don't get involved in this. But a way that they could get involved in this and tackle this market and provide value is by providing secondary financing, which assumable loans don't necessarily say that you cannot do. But it's difficult to do it because you need a lender to be in second position, which most of them don't want to be in. Right. And it's just, I've seen people do it. There's a property in Gig Harbor that was advertising assumable mortgages, that was advertising this ability to get secondary financing. And it's been on my to-do list to call them because they're under contract now. And I'm wondering if they were able to do that. But I want to get some information about that. It was a movement mortgage lender that was providing a HELOC on the purchase, which would now make it so that you don't need to have the extra $100,000 in your pocket. This would open it up to a much bigger buyer pool.
And that's
because
Go ahead.
Well, if you're able to get this on the purchase, because let's back up for a moment. Let's say, so my buyer, for example, who we're getting ready to purchase on, he owns another property. And over the last few days, I had him go out and call his bank and get a HELOC. So he's getting a HELOC against his primary home. He bought it in 2020. It's gone up in value substantially. And he's getting a HELOC. He got approved for $130,000. But he needs to bring $80,000 or $90,000 to this purchase. So he has, the means now to pull that money out. And he's going to be paying a higher interest rate on that, $80,000, $90,000, whatever. But it's worth it. The delta means that he is coming out ahead on this purchase. So he's taking that money. That's effectively a down payment on this new property, and and then we close on it, and he's using this cash because now he has access to the cash from the HELOC. So that's his game plan, and that works great. So anybody who has, rental property or, or a primary home that they plan to keep or whatever, that's an option for them. But then once you've closed on the property, you freed up, you now have the ability to get a secondary mortgage on that, your new primary. So now you move in, because the other thing I forgot to mention, this doesn't work for investors. It only works for owner occupants, because VA, FHA, USDA, all of these government-backed loans need to be owner occupied. So you need to have this doesn't work for my, landlords, but you move into this property. Now you can go and get a HELOC, 90% or in some cases, 95% loan to value. You can effectively get that money back out to give back, to your first HELOC or whatever, in that case, that's paying Paul to rob Peter or whatever. Right. But something that I was having a conversation with another buyer about was talking with their parents, to provide gift funds, pulling a HELOC on their existing property. Yeah. And then once they close, and this buyer, I don't know if it's going to happen, but it's a theoretical situation where they could provide the gift funds, and then after you close on it, you could do this HELOC to pay them back. So if you don't have the cash in your pocket, there are workarounds. Now, that's not going to be something that works for everyone. There's going to be comfort levels there that isn't going to work for everyone. It's there's a lot to unpack there, but there are solutions. I guess the answer is that there's solutions to the problem. If this is something that you're interested in, then I encourage you to explore it and see if there's some problem solving, because it is just, I love creative financing. This is a great creative financing solution out there. Another tool for the belt. Yeah,
for sure. No, you're definitely the king of creative solutions, and that's why I think that you moving in this market has been fun to watch, because you always find a way. And so I think that I appreciate you for that. And I don't think this will be the last conversation. I don't think, there might be someone, if you are someone who's listening and you have more questions, don't worry. We understand. Like, I don't know enough about this, but I do believe that providing our clients with every option available is what we're here to do. And so I like to provide that information. So we do have to wrap up here, but before we wrap up, I have one more segment, and it's called Hot Take. You've done Hot Take before, but we're going to do it again anyway. So are you ready for Hot Take?
Let's do it again. Yeah.
All right. So either or answers. Yeah, round 2. All right. Pancakes or waffles?
Waffles, for sure.
Really? Okay.
Yeah. Waffles. I mean, okay. First of all, my wife loves pancakes. And I'm going to be honest,
I'm a pancake lover myself.
Yeah.
You're not a big fan of either?
I'm not a big fan of either. I'm going to be entirely honest. I know. Okay, here's my thing. I love sweets in the evening, but in the morning, I'm an all savory kind of guy. It's just not my, in the morning, I just don't crave it. Like I drink black coffee. It's not appealing to me in the morning. Now, I will say there's a wonderful restaurant called Waffle Stop in Proctor. They've got the hot Nashville chicken waffle, and boy, that is a treat. And so we will go and get that every now and then. And my wife will get the blueberry lemon one that is very sweet, and she loves it. But yeah, I mean, it's just in general, I'm just not, it doesn't speak too much for me. I'm a big breakfast burrito kind of guy. So shout out to Brewers Row, who we believe has the best breakfast burrito in Western Washington. Oh my guys, it is delectable. So we will, we live in Gig Harbor, but we'll make the trek for that often because it's worth it. Alder and 26th, I think, is where it is. Go try them out.
Shout out to Brewers Row. All right, mountains or beaches for vacation?
Okay, so say as I do and not as I say, whatever. But, mountains. For sure. For me personally, mountains. I love my mountains, especially snowboarding. Winter season, skiing and snowboarding, but then in the summertime, going and exploring and finding a lake. I love the mountains. Now, that being said, almost all of our trips are to the beach.
I know. I was going to say, you got to live with that answer. Jess going to get it. Like,
and that's the thing. Yeah, because, Jess loves the beach. And so, that's what we do. We go to the beach. But personally, I live for the mountains. Every time I go, I just had a listing up in Packwood, and every time I go to Packwood, they don't have sign companies out there. So when I go, I have to put my own sign in the ground. But every time I go out there, I'm driving home like, babe, we need to get something up here. It speaks to me. I love the mountain. I love Packwood. I love White Pass, but I love just getting away to the mountains. There's so much fun to do out there.
Yep. All right. Next one. Coffee or tea? I think I know the answer.
Coffee. Tea.
Yeah, that's easy. That's easy. Books or movies?
Books. I mean, I'm a podcast guy, and I think of Audible as kind of the same thing. I used to read actual physical books all the time, but really, I've switched. I've gone all in on Audible and podcasts.
Okay.
I think of them as the same thing, basically. 4/7. I have my headphones in. Every time I hop in the car, I'm listening to it. And especially now that we have a kid, I don't think we haven't watched anything in a year, basically. The TV's never on.
Yeah, I only watch live sports for the most part, and YouTube. I watch a lot of YouTube. All right, last one, and it's interesting to ask this one depending on what season it is: summer or winter. Do I got you still?
Yeah, I was getting a phone call, and
oh no,
I put it on Do Not Disturb, but apparently it's still
no.
up there,
We ran out of time probably, but last one: summer or winter.
Oh man, summer. I love winter. There's a lot of stuff that I love about winter. I love, skiing and snowboarding I talked about. And, it's nice to cozy up. Like right now, end of summer, I'm kind of looking forward to sweater weather a little bit. But summertime, especially summertime in Washington, my God, it just cannot be beat. The sun comes up at 5 a.m. It doesn't go down until 9 p.m. And it's beautiful outside. Washington has perfect weather. I will fight that to anybody. You don't tell me Florida with all your humidity. No, Washington's the best by far.
I hope no Florida folks see that. Florida folks, we love y'all.
I have two buyers that just moved here from Florida, and so I've been talking a lot of shit about it. There's a bit of a mass exodus going on over there. I mean, like I was literally these buyers. We just got under contract yesterday. They're moving here, and they were talking about their insurance down there. I mean,
going crazy.
Put everything else aside. It is insane. They're paying $15,000 a year for their homeowners insurance. $15,000 a year.
That is pretty. Yeah. Well, I mean, for good reason. I mean, you have.
Well, they can't get insurance down there anymore.
So.
Yeah.
Yeah.
Well, and they're all pulling out because it's like obviously Florida's not going to be there forever, and and they're just getting wrecked every year. Yeah, and then power and they were paying like $600 a month for utilities. Washington, we have the cheapest power in the nation, and we don't have we have water coming out of the ground everywhere. Like,
it's a good place to be.
Anything, Washington is the best place to be.
Especially
see this mountain behind me. This was painted by a photo by one of my clients who gave it to me. I love that thing. It's just such a beautiful place. Every time we're flying in, looking at our beautiful state, I love it.
I do love it here, and we're very fortunate to have what we have around here, especially if you like the outdoors. But all right, I got to get running to my next.
Yeah.
I have one more minute left, so give them your. How do they get in touch with you if they want to hear more about Assumable Loans or just all things Broadie Homes? All right.
Yeah, give me a call. I love to chat. Yeah. You can. Search for Ian Broadie on any social media or the website or wherever, and you'll find me. Give me a call. I love to chat.
Yep, and we'll link it down below, so just make sure you hit that up, and we will have another episode next week. We are in season 9, so thank you for showing up. Thank you, Mr. Broadie, for being on the call, and thank you for all your knowledge.
My pleasure.
This won't be the last conversation about Assumable Loans. As you can see, there's tons to talk about here, and we'll see y'all next time. With that, peace.
Yep, bye.